Good morning. I have come with module 11. So, we have learned the basic concepts computation of residential status, capital and revenue, and all heads of income. Now, we are talking about this module. I am going to tell you about clubbing of income or aggregation of income. So, what is clubbing of income? Clubbing of income, I am going to explain. See, usually, whatever a person has earned income, that only he has to pay the tax. But in some cases, income tax department will find out that the person is trying to avoid tax through certain means. Say, for example, husband is transferring to wife the asset without any consideration, or asset remains in the name of the wife. See, for example, if a house property, it will remain in the name of it belongs to me, but my husband is collecting the rent. So he is a business person or a professional, then he can reduce the taxable income. So these are all the loopholes in the tax structure. So when the income tax department will find out that if there any SSC is doing all this, 8 situations I am going to explain how they can avoid tax by cheating the income tax department, or certain ways to avoid tax. Then income tax department will club the income or aggregate the income. They will consider it as the income of the transferor itself. I am going to explain 8 situations, and this some theory question you can expect from this clubbing of income or aggregation of income. There are no problems for this. So this is a just a theory. I am going to explain 8 situations, and one point I will explain, that is minus income, treatment of minus income. That always I have seen a section A question. Minus income. So that is also important. Minus income we will explain, and 8 situations. So 8 situations you can expect for a theory question. So this is the idea of this aggregation of income or clubbing of income module. Generally, as I told you, a person will pay tax for his own income. That means if I earn some income, I will pay tax for whatever I have earned. Whatever my husband has earned or my son has earned, I'm not bothered about that. So there, I don't have to pay tax for that because they will be treated as separate assessees for the purpose. Now, in the following cases, income of spouse, minor, child, son's wife, or a third person. Third person can be husband's brother, daughter-in-law's sister, daughter-in-law's mother, daughter-in-law's father, anybody like that. Who are people we are taking into confidence just to avoid the income. The asset will remain in their name, but the income will come to us. So that is cheating the income tax department. So in that cases, it will be included in the income of the individual. So this 8 situations I am going to explain. So that is important for the theory questions. So the general rule I have explained. Now I am going to the situation 1. When there is a transfer of income without transfer of asset. Say for example, if Mr. A and Mrs. A. Mrs. A is having a house property. Mrs. A is the wife. Mr. A is the husband. So in this case, what they will do when there is a transfer of income. See, the house property is given for rent. Asset is in the name of Mr. A itself. Husband is keeping the house property, but he is coming in the tax liability. Remember, wife, if imagine if wife is not working. So the rental income from that house property will go to Mrs. A or the wife. What is the idea? She is not, anyway, she is not paying tax. So if this rental income will go to wife, actually she may not be getting the income. Husband will be taking that income. So husband's tax liability can be reduced. Only whatever income, maybe from salary, profession or business, that only he will be reporting to the income tax department. The rental income from house property, though Mr. A is the owner of the house property, rental income, they will make an agreement saying that wife is receiving the rental income. So anyway, wife is not paying tax. So whatever this income, if she will add also, she need not pay tax. So that is the advantage. So in this case, if the income tax department will come to know that Mr. A is the owner of the property, but they made an arrangement, rental income will go to Mrs. A. They will not allow that. They will include the rental income with the income of Mr. A itself. So this is as per section 60. Second situation, when there is a revocable transfer of asset. Revocable transfer meaning you know the meaning. After some time you can change the situation. See, for example, in this case also, if you're taking an example between a husband and wife is not working, then what husband can do that for time being he can transfer a house property to wife's name. See, for example, this year they are going to sell another house property. Mr. A and Mrs. A, the same example I am using. Mr. A is having self-occupied house property plus other two house properties. So what he will do? One more house property he is going to sell that. Two house properties, one he is going to sell that. That meaning he will get some capital gain. He has to pay some extra tax. So for time being, only for 1 year, what he will do? The second house property he will transfer to the name of the wife, saying that after 1 year she has to transfer it back to the husband, only to avoid tax for 1 year. In this case also, whatever income earned from the second house property, it can be rental income or any other income, it will be added to the income of Mr. A. This is as per section 61. Now, situation 3, if the transfer is not revocable during the lifetime of the transferee, it is treated as irrevocable. If the transfer, see, for example, if between husband and wife or wife and husband, or between parents and children, grandparents and grandchild, all this possible, we can transfer the assets. Through will we can transfer. But condition is that if it's an actual transfer, there should not be a condition that after few years, during the lifetime of the transferee. See, for example, if my grandfather is transferred some asset to me, so in that will or in the document he has to say that throughout my lifetime, I am not going to revoke, I am not going to change this transfer. Permanently, I am transferring this asset to me. So that is the irrevocable. Then it is treated as an irrevocable transfer because I am becoming an owner. Now, second point you have to remember, it remains the income of the transferee. So from my grandfather is giving throughout his life, I am not going to change this transfer, and he is giving me an asset, meaning then onwards, whenever I am getting the document, then onwards, I will become the owner of the asset. And whatever income I get, that will remain the income of myself. My income, it will remain my income. So that is it remains the income of the transferee. This is as per section 62. It can be anything. It can be a vehicle, it can be jewelry, it can be a piece of land, it can be a commercial building, it can be a residential building, any transfer. Valuable paintings, valuable expensive watches, anything like that. Silver coins, silver utensils, gold utensils. So all this transfer can be possible, but if it has to be transferred as the income of the transferee, the transferor has to give a condition when he is transferring the asset, saying that in my lifetime, I am not going to change this deal. So automatically the transferee will become the owner of the asset. Situation 4 is any salary, commission or remuneration received by spouse from a concern in which individual has substantial interest shall be included in the income of the individual. So here in that case, see, a person with substantial interest. What that meaning? A person who is holding more than 20% equity shares, 20% or more than 20% equity shares in the concern. So you have to remember that if a person is holding 20% voting rights or equity shares, he is having a major control. So usual arrangement is they will keep their family members, immediate family members, children or spouse to work in that organization. And they can provide some salary, commission or any other remuneration to the spouse or the children working with them. But here the condition is that if he or she is claiming any commission from the organization, he should be qualified, or he should prove that he is qualified enough and he has the he or she has the expertise to collect the income or salary, commission or remuneration from that organization where the spouse is having major control of the organization through the shareholding. So imagine in the case of Infosys, if you take the case of chairpersons, or if you take the case of the founder members, see, everybody has proved that they are capable. They are capable through their qualification, through their expertise. So in that case, if they are getting a salary, commission or remuneration, income tax department will accept that, because they are also PhD holders. They are also proved they have also proved that they are also worked in distinguished organizations, and they can also contribute to the organization through their skill, knowledge and expertise. So in that case, organized income tax department will allow whatever the commission, salary or remuneration paid to the spouse. But imagine the situation if spouse is not qualified. Then whatever salary, commission or remuneration paid to the spouse will not be accepted by the income tax department. So that is the first point. Any salary, commission, remuneration received or remuneration received by spouse from a concern in which has substantial interest shall be included when in which the spouse has substantial interest shall be included in the income of the individual. So when a spouse is said to have substantial interest, you see the third point, a person is said to have substantial interest if he owns 20% or more shares in the concern. Now, second point, if you come, if salary, commission or remuneration is earned by the spouse according to his or her qualification and expertise, it will be treated as his or her income. So that also we have to remember that if the spouse is qualified enough, spouse has got enough expertise, he or she has got enough skill, then there is no problem in working with the spouse organization and claiming all the benefits. Now, this is as per section 64, subsection 1 and 2. Now, situation 5, if income from an asset is transferred to spouse without adequate consideration, it remains transferor's income. Say, for example, in a relationship of marriage, sometimes when the marriage is still valid, that means husband and wife, they are still continuing, they are not living apart. Living apart will be always with a divorce agreement or a separation agreement. So, if they are together and if they are continuing as husband and wife, usually transfer will happen between husband and wife. We have seen that husband and wife, they can transfer their assets. So, whereas if income from an asset is transferred, say for example, I have used the rental income or a machinery can be let out and the rental income from the machinery or any income, shares and the dividend is going to the spouse. So, in that case, if income from an asset is transferred to spouse, see the spouse is transferring without adequate consideration. Without adequate consideration, husband is having shares and the dividend without consideration, it is the shares are transferred to spouse. It remains the transferor's income. So these are all their gimmicks they are playing to reduce the tax liability of the transferor. So in that case, the income from the shares will be added to the transferor's income. Second point you have to remember, relationship of husband and wife must exist on the date of transfer. So if they will start living apart, if there is a divorce agreement or as a first stage for the divorce, they have to live separately for 6 months. So then if that condition is there, then this condition is not valid. If they are still living together and if they transferred the asset without adequate consideration, whatever income from that asset will be added to the transferor's income. Next is the transferee must not be under an agreement to live apart. So if they are living apart, these considerations are possible because you know that alimony they will get, marriage settlement, so many assets they will divide and they will take that. So there in the divorce agreement or separation agreement it is possible, but when the marriage is continuing, this agreement is not possible. Now in case if income from such an asset is reinvested, income from such reinvestment will not be clubbed. Imagine the income what the spouse is getting, he or she has reinvested in something. So the reinvestment income will not be included with the income of the transferor. So this is the situation 5. Whereas income will be added to the transferor's income. This is as per section 65(1) subsection 3. Now situation 6 is if an asset is transferred to son's wife without adequate consideration, income remains the transferor's income. So here also either taxpayer will try to do to the spouse or son's wife. If son's wife is not working, then if she is not earning an income, she will not come in the tax liability. Imagine father-in-law is having so much income. He has to pay huge tax. So what he will do? He will try to transfer some asset just for namesake to avoid the tax payment to the spouse name or to the son's wife name. So in that case also, whatever asset is transferred to son's wife without adequate consideration, then it will remain the income of the transferor itself. Adequate consideration can be if son and wife is going to separate or they are going for a divorce agreement. Then this father-in-law will be transferring certain assets to the daughter-in-law also as a divorce agreement or a divorce settlement. Whereas without anything, if asset is transferred to son's wife without adequate consideration, the income will be added to the transferor's income. This is as per section 64(1)(4). Now situation 7, if an asset is transferred to a third person but benefit from such asset is still accruing to spouse, son's wife or minor child, income from such asset remains transferor's income. Now who can be a third person? We have seen about spouse, we have seen about son's wife. Now who can be a third person? Third person can be wife's sister, spouse sister or spouse brother or daughter-in-law's sister, daughter-in-law's father, daughter-in-law's mother, whomever you will trust. So the idea is just for some time being you are transferring the asset, but the income will continue to come to the assessee. See, for example, if Mr. A is having a property, he has got lot of properties, house property. So what he will do, if you want to avoid tax, and if the daughter-in-law is also earning income, it is, if even if it is transferred to spouse or daughter-in-law, they are also earning members, they cannot reduce the tax liability. So if he will trust the daughter-in-law's mother, father or sister or brother, for time being they will transfer that asset, but they will make an arrangement, income will come to the transferor itself. That meaning that income will be clubbed to the income of the transferor. Even if this is true for a minor child also. Sometimes parents will do that. Minors, they are not paying tax, they are not earning an income, usual case. So there also they can transfer it to minor, but they will see that if it is just an agreement just to avoid tax, then it will be added to the transferor's income. This is as per section 64(1)(8). Now situation 8, income of minor child. I told you this, I have seen that as a section B question, and usually the last point what I am going to explain, the exemption. Usually I have seen as a section 2 mark question. What is the exemption? And the section also is important. Section 64 subsection 1A is dealing with income of minor child. So this is very important. What are the conditions regarding income of minor child? So income of minor child. Some children, they will have extra capabilities. See, Sachin Tendulkar and all, when he was a minor itself, he started earning. So this, some people, they have got extraordinary skill or power and they to earn income. See, in Karnataka, one movie director is there, 8-year-old, 9-year-old boy. He is also earning income, minor child. See, some exceptional kids, they are earning income. So what they will do with the income? So see, this is explained as per section 64(1)(A). So first point you have to remember, every income of minor child from whatsoever the source may be. It can be from playing, it can be from movie, it can be from writing, it can be from YouTube, anything like that. It can be they will have formed a company. I have seen once in a YouTube, some kid, one 8-year-old, 9-year-old boy has formed a company and he is the CEO of that company. He is earning so much income from YouTube. So it will be added to the income of the parent whose income is higher. In that case, if husband and wife, they are working, their taxable income is there. That meaning whoever getting the higher income, this minor's income will be added to the income of that parent. Now, income of a minor child who is physically handicapped or a special child. If it's a physically handicapped child, I have seen that artistic capabilities of physically handicapped children or special children. So they will be making something, they will be doing some creation, creative painting or creative sculptures, all that, and they will be selling for a higher rate. So this income shall not be clubbed with the income of the parent's income. So this, if the child is minor child is a physically handicapped child or a special child, that income will not be clubbed. But if it's a normal child, it will be clubbed. Now a parent in whose income the income of the minor is clubbed can claim exemption of rupees 1,500 per child. See, for example, one child income only is included with the income of the parent. That meaning only 1,500 or the income thus claimed, whichever is less, can be claimed as an exemption. It's for 1 year, it's only 1,500. Usually I've seen that students will write 1,500 per month. It's not per month. For the entire year, 1,500 per child. If the parent is claiming for 2 children, 3,000 he can claim, or the income so clubbed, whichever is less. So this is as per section 10 subsection 32. So this exemption in the case of minor child is important. I have seen that many times they are asking for section 2 marks question. So this, otherwise also how you treat the minor's income, that I have seen you can expect as a section B question. This is what I want to explain with module 11. Now module 12 I will explain set off and carry forward of losses. Some simple problems will be due in that module plus the theory. So I have seen theory questions, but sometimes they may ask one or two simple questions also. So to understand the concept of set off and carry forward of losses, some 2 3 simple problems I will use, and that also I will explain only with the help of one module. So this clubbing of income or aggregation of income problems are not there. That is why I have included only theory. So this is important as a theory question, either section B or section C. And then minor adjustment. What is the exemption for minor? It's important for a section A question. That usually that minus income, what is the treatment for minus income is an important question. And what are the provisions for aggregation of income or clubbing of income? I hope you understood the concept. This is very simple. There's no problems involved. So this just understanding the basic concepts. Thank you for watching, and I request you to subscribe to my channel Ace Commerce with Dr. Alice Mani, because I told you I want you to give the maximum benefit by giving you YouTube lectures for almost all the subjects I'm planning. So however the time available, this I'm completing my income tax full syllabus. So this will be helpful for the students across India, because we have income tax. It's a compulsory subject for at undergraduate level for BCom, BBA, BBM, and postgraduate level MBA and MCom. So this, you please subscribe to my channel and you learn this subject in a simple and systematic way. Thank you for watching. See you with the next module. Thank you.